The morning of October 28, 1929, Jesse Livermore sat in his Manhattan office watching numbers flicker across the ticker tape as millions of Americans watched their fortunes evaporate. While panic gripped Wall Street and desperate investors lined up to sell at any price, Livermore remained calm, methodically calculating his profits. By the end of that catastrophic week, he had made over $100 million, a sum equivalent to more than $1.5 billion in today's money. He wasn't alone in his prescience. Bernard Baruch had quietly exited the market months earlier, sensing the euphoria had reached dangerous levels. Joseph Kennedy, father of a future president, had famously sold everything after his shoeshine boy offered him stock tips, recognizing this as the ultimate sign of a market top. Nearly 80 years later, in a nondescript office in San Jose, California, Michael Burry stared at mortgage data with the same intensity Livermore had once watched ticker tape. A medical doctor turned hedge fund manager with Asperger's syndrome, Burry possessed an outsider's perspective that allowed him to see what Wall Street's brightest minds had missed. The housing market, he realized, was built on a foundation of lies, propped up by mortgages that would never be repaid. While the world celebrated ever-rising home prices and investment banks created increasingly complex financial instruments, Burry began constructing a position that would earn him personally $100 million and his investors $700 million more when the inevitable crash arrived. The pattern that connects these two moments, separated by nearly a century, reveals a fundamental truth about financial markets and human nature. Every generation witnesses at least one spectacular bubble, and every bubble creates a small group of contrarian investors who recognize the madness, resist the euphoria, and position themselves to profit from the inevitable collapse. These investors share certain characteristics that transcend time and technology, characteristics that allow them to see clearly when everyone else is blinded by greed or paralyzed by fear. The story begins not with the crash itself, but with the euphoria that precedes it. In the 1920s, America had emerged from World War I as the world's creditor, its factories humming with productivity, its citizens flush with optimism. The stock market became democratized as ordinary Americans discovered they could buy shares on margin, putting down as little as 10% and borrowing the rest. Why shouldn't they? Stocks always went up. Radio Corporation of America had soared from $1.50 to $570. General Motors had multiplied fortunes. Everyone knew someone who had gotten rich in the market. The mechanics of margin buying created a deadly feedback loop. As more people borrowed to buy stocks, prices rose, making the borrowed positions profitable and encouraging even more borrowing. By 1929, margin debt had reached $6 billion, equivalent to roughly $90 billion today. Investment trusts, the predecessors of today's mutual funds, sprouted like weeds, often investing in other investment trusts in an endless chain of leverage. The Harvard Economic Society declared that a depression was outside the range of probability. Irving Fisher, the most respected economist of his era, proclaimed that stock prices had reached a permanently high plateau. Jesse Livermore saw it differently. He had been trading since the age of 14, starting as a chalkboard boy at Paine Webber, secretly tracking patterns and making imaginary bets in his diary. He had made and lost fortunes multiple times, each loss teaching him valuable lessons about market psychology and his own emotional weaknesses. By 1929, he understood that markets moved not on fundamentals, but on the collective emotions of their participants. When he saw shoeshine boys and taxi drivers discussing stock tips, when he observed the frenzied buying without regard to value, he recognized the final stage of a mania. Livermore's genius lay not just in recognizing the bubble, but in his method of profiting from it. Short selling, the practice of borrowing shares to sell them with the hope of buying them back cheaper, had existed for centuries but was considered almost unpatriotic during the Roaring Twenties. Livermore didn't care about public opinion. Starting in early 1929, he began accumulating massive short positions, using over 100 different brokers to hide his activities. By spring, he was down $6 million on paper as the market continued its relentless rise. Lesser traders would have capitulated, but Livermore understood that bubbles always inflate beyond reasonable expectations before they burst. When the crash finally came, it unfolded with a violence that shocked even the pessimists. On October 24, Black Thursday, 13 million shares changed hands in panic selling. Prominent bankers pooled funds to support prices, creating a brief respite, but the following Monday and Tuesday, October 28 and 29, saw complete capitulation. The ticker tape ran hours behind as orders to sell at any price flooded in from across the country. Margin calls destroyed fortunes in minutes. Former millionaires were ruined before lunch. By November, the market had lost 40% of its value. The aftermath was even worse than the crash itself. Those who bought the dip, believing they were getting bargains, watched their investment shrink further. The Dow Jones Industrial Average, which had peaked at 381, wouldn't bottom until 1932 at 41, a decline of 89%. Banks failed by the thousands as depositors rushed to withdraw funds. The Great Depression had begun, though few recognized it at the time. The optimists who had preached a new era of permanent prosperity were discredited, their fortunes gone, some driven to suicide. Livermore's $100 million profit should have set him up for life, but the same personality traits that allowed him to see the crash coming eventually destroyed him. He couldn't stop trading, couldn't resist the action. He made and lost fortune several more times before taking his own life in 1940, leaving a note that read, "My life has been a failure." Baruch, who had shown more discipline in taking profits and stepping aside, remained wealthy and influential, advising presidents until his death. Kennedy used his fortune to build a political dynasty. The different fates of these men illustrated another crucial truth about profiting from crashes. Making the money is only half the battle. Keeping it requires different skills entirely. Fast forward to the early 2000s, and a new bubble was inflating, this one in residential real estate. The mechanics were different, but the psychology identical. Instead of buying stocks on margin, Americans were buying houses with no money down. Instead of investment trusts, Wall Street created collateralized debt obligations, packages of mortgages sliced and diced and sold to investors worldwide. Instead of the Harvard Economic Society, rating agencies proclaimed these instruments safe, awarding AAA ratings to securities that would soon be worthless. The innovation that would make this crash particularly profitable for those who saw it coming was the credit default swap, essentially insurance on mortgage bonds. This instrument, largely unregulated and poorly understood, allowed investors to bet against the housing market without owning any property or mortgages. It was as if someone could buy fire insurance on their neighbour's house, then collect when it burned down. Even better, multiple parties could buy insurance on the same house, multiplying the potential profits from any single default. Michael Burry discovered this opportunity through the same obsessive pattern recognition that Livermore had employed. While other fund managers relied on models and ratings, Burry obtained the actual mortgage data, analysing thousands of loans individually. He discovered that many were adjustable rate mortgages given to borrowers with poor credit and no documentation of income. These loans had low teaser rates that would reset higher in 2 to 3 years, virtually guaranteeing default. Yet the mortgage bonds containing these loans were trading as if they were safe as treasury bonds. In 2005, Burry began approaching investment banks, asking them to create credit default swaps on specific mortgage bonds he had identified as toxic. The banks, believing housing prices could only go up, were happy to sell him this insurance, collecting steady premiums while considering the risk of payment negligible. Goldman Sachs, Deutsche Bank, and others competed to sell him these instruments. Burry eventually purchased over $1 billion worth of credit default swaps, paying tens of millions in annual premiums while waiting for the collapse. The waiting nearly broke him. As housing prices continued rising through 2006 and early 2007, his investors grew restless. They saw him paying huge premiums for insurance on bonds that kept appreciating. They demanded their money back. Some accused him of gambling with their capital. Burry, certain of his analysis but unable to convince others, imposed restrictions preventing withdrawals. This decision, while ultimately protecting his investors' capital, made him enormously unpopular. He was, like Livermore before him, a lonely contrarian betting against the crowd. John Paulson, running a larger hedge fund, came to similar conclusions but with more capital at his disposal. His analyst, Paolo Pellegrini, had created a model showing that housing prices had diverged dramatically from historical trends. Paulson, initially skeptical, became convinced when he saw that Wall Street was creating synthetic CDOs, derivatives of derivatives that multiplied the exposure to mortgage risk. He realized the financial system had become a massive casino where the same bad mortgages were being bet on over and over again. Paulson's fund purchased $25 billion worth of credit default swaps, a position so large that they single-handedly created demand for more mortgage bonds to bet against. Wall Street, eager to accommodate a client willing to pay hefty premiums, created new synthetic CDOs just so Paulson could short them. It was as if the casino was manufacturing new roulette wheels because a gambler wanted to bet against red. The banks collecting the premiums thought they were taking advantage of a fool. The first cracks appeared in early 2007 when subprime lender New Century Financial filed for bankruptcy. By summer, two Bear Stearns hedge funds that had invested heavily in mortgage securities collapsed. Still, the broader market remained in denial. Federal Reserve Chairman Ben Bernanke declared the subprime problem contained. Treasury Secretary Henry Paulson assured markets that the economy was on solid footing. The rating agencies maintained their AAA ratings on mortgage securities even as defaults mounted. When the collapse finally arrived in 2008, it unfolded with breathtaking speed. Bear Stearns, an 85-year-old investment bank, collapsed in March. Fannie Mae and Freddie Mac, the government-sponsored mortgage giants, were nationalized in September. Then, in a single week that September, Lehman Brothers filed the largest bankruptcy in American history, Merrill Lynch sold itself to Bank of America to avoid collapse, and AIG, the insurance giant that had sold hundreds of billions in credit default swaps without adequate reserves, required an $85 billion government bailout. The profits for those who had bet against the bubble were staggering. Paulson's fund made $20 billion, with Paulson personally earning $4 billion, the largest one-year payday in Wall Street history. Burry's fund returned 489%. Other contrarians like Kyle Bass, Andrew Larday, and Greg Lippmann made hundreds of millions or billions. The credit default swaps they had purchased for pennies were now worth dollars as mortgage bonds defaulted en masse. Yet the very instrument that allowed these enormous profits nearly destroyed the global financial system. AIG had sold over $400 billion worth of credit default swaps without setting aside adequate reserves, assuming housing prices would never decline nationally. When they did, AIG owed more money than existed in its entire balance sheet. If AIG had been allowed to fail, every major bank that had purchased insurance from them would have faced massive losses, potentially triggering a cascade of failures throughout the global financial system. The government's response was to bail out the banks, injecting over $700 billion through the Troubled Asset Relief Program and trillions more through various Federal Reserve facilities. This socialization of losses, while profits remain private, created a moral hazard that persists today. The banks that had created the toxic mortgages, packaged them into complex securities, and sold them to unsuspecting investors were rescued with taxpayer money. Many of the executives who oversaw this disaster received bonuses that year. The pattern revealed by these two great crashes, and numerous smaller ones throughout history, suggests certain immutable truths about financial markets. First, bubbles are not anomalies, but regular features of capitalism, appearing whenever easy credit combines with a compelling narrative about why this time is different. The tulip mania of 1637, the South Sea bubble of 1720, the railroad boom of the 1840, the roaring 20s, the dot-com bubble, the housing bubble, and today's everything bubble all share the same psychological DNA. Second, the mechanisms for profiting from bubbles have evolved, but the underlying principle remains constant. Bet against the crowd when euphoria reaches extremes. In 1929, this meant short selling. In 2008, it meant credit default swaps. Today, it might mean put options on overvalued technology stocks or cryptocurrencies. The specific instrument matters less than the ability to recognize when prices have detached from fundamental value, and the courage to act on that recognition. Third, the investors who successfully profit from crashes share certain characteristics that seem almost contradictory. They must be both deeply social, understanding crowd psychology and market dynamics, and profoundly antisocial, willing to bet against everyone else. They must be both patient, able to maintain losing positions while waiting for the collapse, and nimble, ready to act decisively when the moment arrives. They must be both skeptical, questioning, received wisdom and popular opinion, and confident, trusting their analysis even when the entire world disagrees. The next crash, when it comes, will likely follow the same pattern, even as its specific causes differ. Perhaps it will be triggered by corporate debt, which has reached record levels, as companies borrowed heavily in an era of near-zero interest rates. Perhaps it will be sovereign debt, as governments worldwide have printed money and accumulated obligations that can never be repaid in real terms. Perhaps it will be in cryptocurrencies or artificial intelligence stocks or some asset class that doesn't yet exist. Already, there are signs that a new generation of contrarians is positioning for the next collapse. Some are buying credit default swaps on corporate bonds, betting that the massive debts accumulated by zombie companies, firms that don't earn enough to cover their interest payments, will eventually default. Others are accumulating put options on popular stock indices, wagering that the everything bubble inflated by central bank money printing will eventually deflate. Still, others are buying volatility, betting that the artificial calm maintained by constant government intervention will give way to chaos. The most successful among them will be those who combine the pattern recognition of Jesse Livermore with the analytical rigour of Michael Burry. They will need Livermore's understanding of market psychology, his ability to read the tape and sense when sentiment is shifting. But they will also need Burry's discipline to dig deep into data, to understand the specific mechanisms by which the bubble will burst. They will need to identify not just that a crash is coming, but how to profit from it without being destroyed by its timing. The timing is crucial because being early is often indistinguishable from being wrong. Livermore was early in 1929 and suffered paper losses before his ultimate triumph. Burry was early in 2005 and faced investor revolt before vindication. The next generation of crash profiteers will likely face similar challenges, maintaining expensive hedges while markets continue rising, facing ridicule and criticism for betting against prosperity. Yet, history suggests they will eventually be proven right. Every bubble in history has eventually burst. Every mania has ended in panic. Every period of excessive speculation has been followed by a sobering return to reality. The only questions are when and how severe the reckoning will be. Those who can answer these questions correctly stand to make fortunes that dwarf even the spectacular gains of 1929 and 2008. The infrastructure for the next crash is already in place. Exchange-traded funds now allow investors to bet against entire markets with the click of a button. Options markets have exploded in volume, providing leverage that makes the margin buying of the 1920 look conservative. Cryptocurrencies have created entirely new ways to speculate, with some coins rising thousands of % before collapsing to zero. Social media has accelerated the speed at which manias can form and burst, compressing cycles that once took years into months or weeks. The role of central banks has evolved from lenders of last resort to active market participants, buying not just government bonds, but corporate bonds, and even stocks. This unprecedented intervention has created what some call a everything bubble, with stocks, bonds, real estate, and alternative assets all trading at historically high valuations simultaneously. When this bubble bursts, there may be nowhere to hide except for those who have positioned themselves to profit from the collapse. The ethical implications of profiting from crashes remain contentious. Critics argue that short sellers and crisis profiteers contribute to panics, accelerating declines that destroy wealth and jobs. Defenders counter that they provide valuable price discovery, exposing frauds and excesses that would otherwise continue growing. The truth likely lies somewhere between these extremes. While some contrarians are merely gamblers seeking to profit from others' misfortune, others play a vital role in maintaining market efficiency and preventing bubbles from growing even larger. What remains constant is human nature itself, the tendency to extrapolate recent trends indefinitely, to believe that this time is different, to be swept up in the madness of crowds. As long as these traits persist, there will be bubbles, and as long as there are bubbles, there will be those who recognize them and position themselves accordingly. The same investors who made billions in 1929 and 2008 may not be around for the next crash, but their intellectual heirs are already preparing, studying history, analyzing data, and waiting for the moment when euphoria turns to panic. The ultimate lesson from these episodes is not that everyone should try to profit from crashes. Most who attempt to time the market fail, selling too early in bull markets and buying too early in bear markets. The average investor is better served by patient, diversified investing rather than attempting to predict catastrophes. But for the rare individuals with the skill, discipline, and emotional fortitude to bet against the crowd, crashes represent the opportunity of a lifetime, a chance to make fortunes that would be impossible in normal market conditions. As we stand today, with markets at all-time highs and valuations stretched by any historical measure, the question is not whether another crash will come, but when and what form it will take. Somewhere, modern versions of Livermore and Burry are analysing data, building models, and placing bets that seem insane to everyone else. They are paying premiums for insurance no one thinks they'll need, buying puts on stocks everyone loves, shorting bonds everyone considers safe. Most of them will lose money, their timing off or their analysis flawed. But a few will be spectacularly right, and when the next crash arrives, they will profit on a scale that seems impossible today. The cycle will then begin anew. The crash will create buying opportunities for the next generation of investors. Regulations will be passed to prevent the specific problems that caused this crash, even as the seeds of the next one are being planted. Memories will fade, lessons will be forgotten, and eventually, inevitably, a new narrative will emerge about why this time is different, why the old rules no longer apply, why assets can only go up. And when that narrative reaches its crescendo, when taxi drivers are again giving investment advice and shoeshine boys are discussing derivatives, a new generation of contrarians will begin positioning for the next great crash, continuing a pattern as old as markets themselves.